Crypto trading strategies. Day trading cryptocurrencies can be an exhilarating activity for traders. However, it's also one of the more difficult timeframes to trade. Cryptocurrencies tend to exhibit higher intraday volatility than in many other financial markets, thereby requiring a greater level of skill to trade short time frames successfully. As we navigate this dynamic landscape, we want to equip ourselves with the most effective strategies to maximize our gains and minimize risk. In this article, we'll delve into the realm of crypto day trading and present a list of the top 10 strategies to consider. Whether you're a seasoned trader or just beginning your trading journey, get ready to explore the fast-paced arena of crypto day trading. What is crypto day trading? Crypto day trading is defined by a trader's expectation of entering and exiting a trade within the same day, also referred to as intraday or one-day time horizon. Therefore, being able to interact with intraday price dynamics is critical. How a trader engages the market during the time horizon will depend on the strategy deployed. Nevertheless, in general, traders will be looking for smaller price movements based on intraday market behavior. By trading intraday, traders can use tighter risk parameters than for longer time frames and adjust their allocation size accordingly. Since the average size of a trade is larger than that used for a longer time horizon, given the smaller expected movement. In addition, there are no overnight holds in day trading, so that risk is eliminated. Top crypto day trading strategies. 1. High-frequency trading, HFT. High-frequency trading, HFT, is driven by automated mathematical algorithms that execute orders in fractions of a second based on preset criteria. These algorithms manage a high volume of orders, aiming to capitalize on minute price movements over extremely short time frames, often mere seconds or fractions of a second. The lightning-fast speed of HFT necessitates the use of trading bots. By handling substantial order sizes, HF traders contribute to the liquidity of the cryptocurrency market. The primary objective of a high-frequency trader is to optimize speed and minimize transaction costs, prioritizing efficient execution and cost-effective transactions. 2. Buy and hold. Hodling is an investment technique devised from a misspelling of hold, in which people buy cryptocurrencies and keep them for a long time. This permits investors to profit from an increase in the asset's value. So, how to take profits in crypto with the HODL strategy? Hodling lets investors take profits from long-term value appreciation when they invest for an extended period. Investors can benefit from the HODL strategy since they are not subject to short-term volatility and can avoid the risk of selling low while buying high. As cryptocurrencies have a short history compared to commodities like gold and silver or fiat currencies like the United States dollar and euro, they are prone to fraudulent activities such as money laundering. Therefore, some countries may not support cryptocurrencies, affecting the value of digital assets. 3. Scalping. Scalpers capitalize on short and rapid price movements, often utilizing automated bots to increase trade frequency in order to profit from tiny price fluctuations through resale. Compared to longer time frames, scalping involves higher frequency, larger trading volumes and bigger positions, as the targeted price changes are relatively smaller. Consequently, it's essential to consider trading costs, as they can consume a significant portion of the trader's revenue. Scalping can be risky, as reliable patterns become more difficult to identify and exploit within a shorter time frame. Therefore, scalpers need to adhere to a strict exit strategy, ensuring that a single substantial loss does not negate the multiple small gains achieved. Scalping can be approached in two ways. The first approach involves executing many trades at high volume to capitalize on concise and fast price movements. The second approach adopts a slower trading process, relative to high-frequency scalping, and focuses on slightly larger but still relatively small price movements, a lower number of trades, smaller position sizing and slightly longer holding periods. 4. Range trading. Cryptocurrency markets are constantly oscillating between trending and consolidation environments. Range trading involves leveraging consolidation periods to profit from a predefined price range. The range is defined by key levels of support and resistance, often represented by classic consolidation patterns such as rectangles or symmetrical triangles. In range trading, traders seek to enter a short position or close a long one at resistance near the top of the range where resistance is encountered. Conversely, they may also aim to initiate a long position or close a short one near the bottom of the range around support. Stop-loss orders are placed beyond the extremes of the range to mitigate risk from adverse price movements. 5. The diversified investor. Long-term asset holding is a common practice among investors. Unlike swing or position traders, their objective is often portfolio diversification rather than a simple bet on price appreciation. Exchange-traded funds, ETFs, which trade on a stock exchange but hold a sizable amount of cryptocurrency assets, are most likely how investors will obtain future exposure to the crypto market. For instance, an investor might buy crypto assets to spread out the risks associated with equity. Cryptocurrencies can be employed in a portfolio to balance the risk of a substantial decrease in equity prices because they typically have a poor or negative correlation with equities. Cryptocurrency assets themselves may also have substantial upside potential. Trend following. Trend-following traders look to capture a prevailing trend as much as possible. The type of trend they focus on depends on their primary time horizon, which can be short, intermediate, or long-term. Trends can be traded on any time frame chart, and traders frequently rely on trend indicators such as trend lines and moving averages to guide their decisions. Counter-trend trading. Price movements occur in trends, consisting of price advances in one direction, up or down, followed by retracements or countertrend moves. Countertrend traders seek to capitalize on these corrections within larger trends. This is considered a somewhat riskier strategy than trend trading and requires greater skill. By trading against the larger trend, countertrend traders take on more risk, as they're going against the dominant force, up or down, at the time. 7. Market sentiment analysis. Understanding market sentiment is crucial. It drives the rise and fall of markets based on changes in the confidence of market participants. Market sentiment represents the collective attitude of investors and traders toward a specific financial asset or the overall market. By analyzing market sentiment, traders can identify changes in attitudes and confidence that can influence changes in supply and demand, and, consequently, prices. Some elements of market sentiment analysis include the Fear and Greed Index, Bitcoin Dominance Ratio, news, social media, and Google Trends. Bitcoin Dominance Ratio. The Bitcoin Dominance Ratio measures the market capitalization, market value, of Bitcoin to the total market cap of the entire cryptocurrency market. This ratio wields an influence over the overall market, as many smaller capitalization coins follow Bitcoin's trend or have some connection to it. A declining ratio suggests that altcoins are doing better relative to Bitcoin. If you find this video useful, don't forget to like and subscribe to our channel.